the same way. Never. So this is PIL method, which is our technology company, stands for prepayment of principal, isolation of principal amounts, leverage, and liquidity. Those are the four moving parts. Now this algorithm here that you see on the screen, let me enlarge it so you can see it another way. This is the algorithm that the banks use to amortize interest on all loans. There hasn't been any changes to this algorithm in the last 81 years because the mortgage started in 1934. Okay? Hasn't been any changes to it, not to benefit consumers. None. Why? Because it makes a ton of money for the banks. Can we agree? Because in any city, the biggest builders are either insurance companies or their banks, aren't they? So it makes a ton of money for them. Now then, if they use some critical thinking here, if they use it to make money, then what should you be using to save money? The same thing. Doesn't that make sense? It's a no-brainer there, isn't it? So why are we in the year 2016 still using spreadsheets and pen and pad and calculators? How can you possibly defeat them at their own game when they're spending millions and billions of dollars of technology to defeat you? And so then you go back to them now and you say, I want to pay this loan off. Can you make a recommendation to me? And they say, well, yes, sir. Meanwhile, their technology is moving in the background and say, well, if you want to pay this mortgage off, just make bi-weekly payments on this thing. And you'll pay it off early. Yeah. Meanwhile, you hear their robust systems moving in the background, making money off of you, and they're handing you a little tool, and you say, thank you, sir. And that's how we handle our debt. Am I correct?
That's correct.
Can't beat them at their own game. Not by doing that. This is a David and Goliath moment here, isn't it?
Yes, it is.
Here's what lenders don't want you to know. They don't want you to know how deceptive amortized interest really is. The interest rate that you're quoted is not the interest rate that you actually pay. Let me break it down to you. You tell me if I'm wrong, because at the end of the day, Chima will tell you, the math doesn't lie. So here's a $500,000 loan at 3%. Can we all agree 3% is a good interest rate?
Yes.
That's the monthly payment, $2108. If we make every payment on time and we're never late for the course of 30 years, here's the total amount of interest we're paying on that, $258,000. Now, you take the interest, add it to what we borrowed, now we're paying back to the bank $758,000, are we not? I'm going to ask the question again. Does that now look like 3% to you? So in actuality, it's 51% loan all day long. I don't care how you cut it. This is what you quoted, this is what you pay. So let's look at it a little further. That same $500,000 at 4%, we're paying back now $359,000. It's a 71% loan now, isn't it? At 5%, $466. This is where it gets tricky. At 6%, now we're paying back more in interest than what we actually borrowed, correct? And in Bermuda, where I worked year before last, they're at 7%, $1 million homes over there. It's 140% loan all day long. That's what's going on. So here, let's break it down. Here's a $300,000 loan at 4.25%. We can clearly see the interest paid in the first month is just over $1,000, isn't it? Look at what we paid a principal in the first month, $413. The total interest paid in the first year is over $12,000. The total interest paid out in the course of 10 years is $115,000. And that's an average of $962 a month for 10 years straight. This is what we're doing. So in 10 years, you've paid $670 that we got a benefit for towards the principal, but look what we paid out to the bank totally. It's $177,000. For those of us that are in real estate, we don't want to continue to do this. So let's set some rules. Here are the rules in everybody's loan documents. It's called prepayment of principal amounts. You have this in all of your loan documents to call the borrower's right to prepay. You have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. When I make a prepayment, I will tell the note holder in writing that I'm doing so, correct? Now let's agree on something. When we make a prepayment, that money goes directly to the principal, right? How much of it goes towards the interest?
Zero.
I'm asking one more time because I'm agreeing with you. I want to make sure we understand this. When we make a prepayment, that goes directly to the principal. And how much of it goes towards the interest? Zero. Okay, now that we got that, I'm not here to explain to you how to make prepayments. I only want to show you the power of it. Here's a $200,000 loan at 6%. That's the monthly payment on this, $11.99. Here's a summary of this loan. We can clearly see it's no longer a 6% loan, is it? It's 115% when we look at all the interest that we actually pay to the bank. Let's now look at the amortization schedule. Here's how it works. Let's assume that we're making our very first payment on this loan in January. When we make January's payment, correct? We can clearly see of the $1,199.10, $199, this is what we get the credit for, right? This is what goes towards our principal for the very first month. Can we agree that $1,000 of interest is the bank's fee for that month?
Yeah.
We subtract the $199.10 from the $200,000, and now it gives us the principal balance right here, the $199,890, correct? That goes into that algorithm or the formula that I shared with you, and all it simply does, it determines the payment configuration for the very next month. So then, it would be February now, correct? So when we make February's payment, we now have $1 more going towards the principal, correct? And $1 less going towards the interest. We're well on our way to paying this off, aren't we? So now then, we subtract the $200.10 from the previous balance. Now it gives us our new balance, correct? This month-end balance here now will determine the payment configuration for what line now? On line 3, correct? So this will be March's, correct? So when we make March's payment, the bank gets the $2,110 and now the $998, correct? Now let's look at prepayments. Can we agree? This is February's principal payment right here, isn't it? Once we make January's full payment, do we have to wait to give this to the bank in February? We could give it to the bank early, could we not? And give it to them in January. So we make January's full payment, January the 1st, and then in that same month, Jarvis, we're going to write a separate check to them for the $200.10 and tell them in January, please apply to principal. If we did that in January, we're paid down to here, correct?
Yes.
So then when we make February's payment, we're on what line now? We're on line 3, correct? Because we paid this in January, prepaid it in January, correct? This is our balance. Always look at your month-end balance. Wherever you are on here tells you where your next payment is going to be due, correct? Which means that our next payment now is going to be on line 3. Since we have to make a payment every month, March's payment just moves up one to February, correct? So when we pay the $11.99, the bank gets the $201.10 and the $998, correct? Here's my question to you, for those of you who haven't seen this. If we made January's payment here and prepaid this, and we're making February's payment here, what happened to the interest of the $9.99 on line 2? Say that again?
There is none.
Exactly. They never received that, did they? We never paid it, did they? Did we? So what we're realizing is the principal and interest are connected to each other, aren't they? If we prepay this, we just eliminated almost $1,000 of interest that the bank did not have to receive by prepaying it. Because you said to me, when you make a prepayment, you're looking at me now like I'm crazy. You said when you make a prepayment, that goes directly to the principal. And then I asked the question, how much of it goes towards the interest? And what did you tell me?
Zero.
It's exactly what you told me. I'm only using your instructions here. Okay? So let's get smart with this. What if we, in the same month, give the bank the $210, the $201.10, and $202.10 in that same month in January? Is it fair to say if we make that prepayment, I see you doing the math already in your head, when we make February's payment, what line will we now be on? So for $600 that we would have had to give to the bank anyway, roughly how much interest did we just cancel? $3,000 of interest. How powerful is that? Has anybody showed this to you this way before?
No.
No. This is everybody's loan documents. There was no class on this before? No. You took the class for me.
Tore that page out the book.
See, here's what we're starting to learn. We're starting to understand what we call the power of the penny here. See, if $200 paid on principal saves us $1,000 of interest that we never have to pay, doesn't that mean $100 now saves us $500 of interest? Break it down further. $50 now saves us $250, doesn't it? $25 saves us $125. $12.50 saves us $75. And a $6.25 cup of coffee is really worth $37.50 to you at the end of the day when you look at it that way. See that? $3.13. You can see 38 and change. Let's break it down all the way down to the penny. What you're starting to learn is small amounts of money can cancel huge amounts of interest at the end of the day.